Today's session is cash flow forecasting. I'm Desiree Brown, Senior Communications Manager here at the Tory Burch Foundation, and I'm so happy to have Hannah Smolinski here with us today. Hannah is a CPA and the founder of Clara CFO Group, a virtual CFO agency providing small businesses with financial clarity and profit maximization strategies. So after today's presentation, we will have plenty of time for Q&A, so be sure to ask questions in the Q&A box, and we'll get to as many as we're able before we get to 2 o'clock. Quick reminder that today's session will be recorded, so please watch your inboxes for the replay link, as well as some materials from Hannah. And with that, Hannah, I'm going to turn it over to you.
All right. Well, let me go ahead and get my slides up here. Give me 1 second and we'll get going. All right. So today's topic, cash flow forecasting. Thank you guys for being here. I know that sometimes cash flow can feel a little intimidating, but I think we all would like to see a little bit more cash flow in our lives. So thank you for being here. And that's hopefully what we're going to do today is help you facilitate that. I will go ahead and just briefly, I got a little bit of an introduction. I'll tell you a little bit about the company and why I'm here talking about cash flow today. So I'm the founder of Clara CFO Group, and we provide CFO services for small businesses. So this is what we do with clients all the time, helping them figure out what their cash flow looks like in the future. We do that when we also do other financial analysis and planning. We also create a lot of financial tools like the one we're going to show you today, and then we do workshops as well. So things like this is what we do. We also have financial education and media. So we have a YouTube channel, currently has close to 60,000 subscribers there. So you can join us on YouTube. And then we also have just started a podcast as well. So if any of those look exciting to you, we have a way for you to find those later on in the presentation. Okay, so the first thing that we're going to do to get started today is just take a deep breath. And I want everybody to do this wherever you are. We've got about a bunch of people on the webinar today. And I want you to just take a deep breath in and out. And this is going to help us just center with what we're going to talk about today, but it's also going to help us think about cash. So cash is like the breath in our business. And I think one of the things that we need to think about is that with any kind of successful business, we have cash coming in and cash coming out. Sorry, I'm just going to go ahead and take a quick breath myself. I think I just got a little bit excited to get started to talking to all of you guys today. So with cash, we want to think about the fact that cash coming in and cash going out is really important. And we're going to always have that kind of regular cadence, of cash coming in and cash coming out, just like our breath. We don't want to think of cash like the lifeblood of our business, because the lifeblood of our business means it's like a closed loop situation. But that's not the case. We have breath coming in and breath coming out, and we have to have that in and out in order for our businesses to survive. So with that, what is cash flow forecasting? So cash flow forecasting is really all about having a practice of being able to do something on a regular basis to help predict the balance of our cash in the future. Okay, so cash flow forecasting is not something that we do one time, like a budget, where we just budget at the beginning of the year and then we just, go from there. Cash flow forecasting is something that we do, either on a weekly basis, every 2 weeks, or potentially, every month as well. And all of the goal of that is to help figure out, well, how much cash are we going to have in the future? So why do we predict cash flow? Cash flow is going to be one of those things that if we can predict it in the future, it's going to help us facilitate making better decisions. So if we can make better decisions by putting it into a cash flow forecast, it will help us, feel more confident. So it'll instill confidence and create more peace of mind in our businesses. With that as well, it's also going to help us create a more financially sustainable business, because if we're going to potentially make a decision, we're going to be able to know, is that a good thing for our cash in the future or a bad thing? So lots of reasons why we want to predict cash flow. If you looked at some of the marketing materials for this webinar today, you'll see that there was a stat that was posted that said 82% of businesses that failed often cited cash flow as being part of the problem. So we do not want you to be part of that statistic. We don't want you to have that be a problem in your business. So thank you for being here. The forces of cash flow. So in order to accurately think about forecasting cash flow, we need to think about what are the ins and outs, that breath that we talked about, cash coming in and cash going out. There's a couple different ways that cash comes into our business. And the number one way is going to be your revenue, your sales. What are you selling? Are you selling products or are you selling services? When people were saying hello at the beginning of the webinar, they were saying like, we had some service-based businesses, we had some product-based businesses, we had some brand new businesses, lots of different things. So that cash coming in on the revenue side is going to be probably the largest part of what's coming into your business, hopefully. Now, we will have some businesses that are pre-revenue where they've got outside investment coming in, and that's another great reason to use cash flow. We also can have cash coming into the business from borrowed money. So if you've got a loan or a line of credit, or maybe you're borrowing from friends or family, that would be considered borrowed funds. And we can also have outside investment. We can have outside investors. We can have, things like crowdfunding. We can have lots of different ways that people can invest in our businesses. And then also the owners of the business can infuse cash into the business. Those are the main ways that you're going to get money coming into the business. There's going to be a few other ways here and there, but for the majority of us, this is going to be the way that cash comes into the business. And then cash going out of the business will be things like regular operating expenses. So, paying payroll, paying your rent, paying your software, all the things that you need to do just to operate your business. That's your expenses, and that costs money, and that's money going out. And then we also have things like taxes, federal, state, local taxes. Those are also money going out. And a lot of times those taxes are not actually showing up on our profit and loss statements, which we'll be able to see the revenue and we'll be able to see expenses. But sometimes the taxes kind of lurk in the background, and then we get hit with, the fact that we need to pay taxes. And sometimes it's like not really, it can be a surprise. So we need to think about taxes when we think about cash outflows. We also need to think about debt repayments. So if you have a loan or a line of credit that you need to pay back, or even just a credit card, or maybe an equipment loan, lots of different things, that's also money that will be going out of your business. Now, another thing that we will spend money on is capital purchases. So this will be things like buying equipment for your business, buying a truck or a car, buying furnitures and fixtures if you're building out a retail space. This will also be even maybe saving money or investing money on the side if you're trying to build up your savings. That would all be like capital expenditures. And then we also have owner's distributions. And this is something that constantly gets forgotten, because people think this shows up in their regular expense line. If we're looking at the cash outflows here, they'll think that that's included in expenses, but actually owner's distribution is not included in your profit and loss statement. So it's another thing that sometimes gets forgotten about when we're really thinking about the needs and the cash flow in a business. So what are some warning signs that you might have a cash flow problem? Now, you might just be like, hey, I know I have a cash flow problem, and that's why I'm here today. But there are some other things that we can think about, and some indicators if we have some cash flow problems, and we do need to be thinking about cash flow forecasting and thinking about ways to increase cash flow. So number one is obsessively reviewing your bank balance. Now, I know sometimes even people that have tons of money still obsessively review their bank balance, but usually the reason you obsessively review it is because if you're really worried about the timing and you're worried you're not going to have enough money to do something, that's a really good indicator that you might need to work on your cash flow. Another thing is to not have any business savings. So if you don't have any business savings, then that probably means your business is not generating enough cash to actually start adding into the cash flow and building that up. Now, also, if you're not able to pay your bills all on time and you're trying to time them to say like, well, maybe that bill I can pay a little bit late. Maybe that bill I can pay a little bit later. If that's the case, then you probably have cash flow problems. If you're relying on debt for normal operations. So if you're constantly looking to borrow from your line of credit just to make payroll and you're doing that over and over and over and over again, and that debt is starting to increase, again, cash flow. High accounts receivable. So let's say that you have invoiced your customers or your clients and they are not paying you, and that accounts receivable balance keeps building. That's another sign that you might have a cash flow concern. And then really just, do you have constant worry and stress about your cash? If you do, then you're in the right place. We're going to start figuring out tools and ways to help you gain more control over your cash. So in order to do a financial cash flow forecast, here are some things that you need in order to put that together. We'd like you to be able to have an income statement. So this would mean that, for all of our new businesses that aren't yet in an accounting system, this is something that we would highly encourage you early on in the process to get into an accounting system. But most of our businesses that have existed for a while, you're going to have access to your bookkeeping software. So that's QuickBooks or Xero, or maybe it's FreshBooks, something like that. You can pull an income statement from those software providers. An income statement, we like to see those ideally on a month-to-month basis. And I like to usually pull like 6 to 12 months to be able to kind of see that as I'm preparing a cash flow forecast. Actually, I like 12 months. I'm just going to say I like a month-by-month, 12-month income statement so that I can see what's happened in the past 12 months. And then we also like to have a balance sheet. This again comes from your accounting system. And this is something that your bookkeeper can pull for you, or you can get it in your accounting system as well. And ideally, if you have a budget, we want to have that as well. Now, I understand that not everybody has a budget, and that's okay. Well, ideally, I want you to have a budget as well. I want you to have a cash flow forecast, and I want you to have a budget. But if you don't have one, that's okay. You can still go through this exercise. The income statement and the balance sheet will help you prepare what you need here. And the last thing is you need some kind of cash flow forecast spreadsheet. This cash flow forecast doesn't come out of your accounting system. Now, sometimes they'll have something. I know QuickBooks just came out with a cash flow forecast, but honestly, it's not at a place where it needs to be yet. So we like to do this in a spreadsheet. And don't worry, I have one for you. So you can also like Google and find one, but I have one for you. So it'll make it easy that way. Okay. So cash flow forecasting spreadsheet. I'm actually just going to show you guys what this looks like after I take a little sip here. I'm going to show you what this looks like because this is kind of where we get really hands-on in this webinar today. And I don't know if you were planning to look at spreadsheets today, but I'm going to show you spreadsheets and I'm going to walk you through how to use this thing, and then also how to use a forecast spreadsheet like this to make decisions. So the whole point of what we're doing here is so that we can make decisions for that more financially sustainable business. And so if we, know how to use this well, you can leverage it and use it in your business. So I'm going to switch over here to our forecasting spreadsheet. And so I want to make sure that everybody can see that. I think we're good. We can see the spreadsheet, right? Desiree, if you want to tell me.
It looks great, Hannah.
Okay, good. Okay, I just want to make sure that I shared the right way. Wonderful. Well, thank you. So this spreadsheet is set up in a way that it can be customized for any kind of business. But this has those forces of cash flow that I was telling you guys about before. So we have revenue. This is cash coming in. And it starts out with cash at the beginning of the period. So you can type in something here, like if you had $20,000 at the beginning of the period, it will, and then maybe you make $5,000 in the month, and it will kind of do all the math for you. So I'm just going to plug in some numbers here. Here's some of that cash out. These are like your expenses that you would find on your profit and loss statement. These are income items that you would find on your profit and loss statement. Cash out you would find on your profit and loss statement. And that would be for things in the past, but you would use that information from the past to help predict what you have in the future. So let's say like, if you know, the type of revenue that you have, you can project that into the future. Revenue is always the hardest to project in my experience. But things like expenses, like maybe you have the same amount of people on your payroll every month, or it's like within an average, you can predict that out into the future. You would probably know what your rent is because you have a rental agreement, there's a lot of expenses that we have that we can project into the future and have a good sense of what they would be. Now, this is where a budget would come in handy, because if you had a budget, you could go ahead and put in all of that information into the future in here, because you've already done that exercise of trying to estimate what your expenses are. But if you don't have a budget, you could do that kind of exercise to go line by line and say, okay, I typically spend this much on cost of goods sold, and you can put that into your projection. I typically spend this much on payroll and put that into your projection, and so on and so forth. And then you can also customize this. You can always add lines and stuff too. I will show you in the next example that this has been customized a good bit. And then we have the other forces of cash flow coming out. So things like credit card payments, loan repayments, owner's draws, tax savings, other savings or tax payments. That's other things going out. And then other cash coming in would be like cash received from a loan or cash received from an investment. So we have all of those things kind of factored in here. So what this will do is it will tell us kind of overall for the period of time, how much did your cash change for the month? And then what's your cash at the end of the period? So in this situation, with the two numbers I put in, there's $4,000 of extra cash. And then at the end of the period, we have $24,000. So all of this, and we can also do a little bit, we can put in a little indicator down here that says, don't let cash go below a certain amount. And then this will highlight if our cash gets too low. Okay, so that's just how the spreadsheet works. Now, a lot of people will do like a weekly spreadsheet. So if your cash flow is really tight and you need to know when your credit card is hitting and when your payroll is hitting, and you need to, maybe start out because cash is really tight, you need to have that week by week. You can change this and make this week by week. Totally fine to be able to do that. There's lots of weekly cash flow templates as well. You would just draw this out so that you use weeks instead of months. And sometimes people need to do that if cash is really tight and you're needing to time, I pay this bill here, I do this here, we would do that. But once you get into a place that you have enough cash coming in and you're not having to do that little game, and maybe you have a buffer in your cash balance, then you can move to a monthly cash flow, which is a lot. It's kind of takes some of that pressure off a little bit, and you don't have to worry about the minute little timing between the credit card going out on this date and payroll going out on this date, because you know that overall you're going to have enough cash in your account. So that's the spreadsheet. I wanted to show that to you guys, and this is going to be available to you in the download. What I wanted to show, though, is the example that we've created. So we've created a business for the purposes of this presentation called Pure Joy Agency, and we're going to walk through some scenarios and decision-making for Pure Joy. We've named it Pure Joy because we think your business should be pure joy, and also be making you a profit and having lots of cash come into your business. So this business is a digital marketing agency. And the revenue model that we've put together here is a retainer model. So what that means is our clients in this business are going to be paying us a set amount every single month. We really like this kind of model. It definitely helps with cash flow. And kind of for giving a simple example for you guys, I think this is helpful. They have 10 employees, and they also have a varying amount of contract labor, which is pretty common in a digital marketing agency. We've also got a repayment of a $75,000 EIDL loan. There's one owner. It's an LLC, taxed as an S corporation. And it's got a $1.5 million revenue target. And right now they have a physical location that is rented. So that gives you like a little bit of a lay of the land for this, because I'm going to go in and show you what a cash flow forecast could look like for a business like this. Okay. And then I am going to probably need to like zoom in and out a little bit. I'm going to move my things around here so I can see everything. All right. So to show you what that looks like, we have this retainer client income. I've customized this over here. And I've also added in this column here to show you the assumptions that I made to come up with the forecast. Now, I've assumed everything here because I've made this business up from scratch, but to kind of show you where I supported the numbers from, we created a retainer clients tab here where we have our business names and then our monthly retainer for each client. And this is going to help us, project revenue out into the future. And then we also have our employee costs for payroll. So we have our employees here with salaries, taxes, benefits, fully loaded cost, and then a monthly cost of each employee. So that's coming into our payroll cost here. But we've put in some numbers here, trying to look at, what type of business we're looking at. We threw in some numbers. They have general office expenses and software. I recommend for a cash flow forecast to not go nitty gritty to every single line item on your P&L, but rather maybe to summarize it a little bit more to like higher level groupings. So office expenses probably includes lots of different things like meals and, office supplies and maybe a couple other, little things here and there. But I find you could take a lot of time projecting out each little line item like that. And sometimes it's diminishing returns on that time. So in that situation, we try to just kind of do more high level forecasting. Because remember with a forecast is that you're trying to get directionally correct. It's not going to be perfect. So if your forecast is correct down to the penny or down to the dollar in 5, 6, 12 months from now, you probably just got really lucky. It's probably doesn't have anything to do with exactly the quality of the forecasting, but more just the luck of everything falling into place the way that it should. So just keep in mind that we're trying to get close, and we're going to get much closer by doing this exercise rather than getting to a place where, you're not doing anything. So we definitely want to do something rather than nothing here. So I'm just going through here. We have conference expenses and marketing, and then we have the debt repayment here. And then we've got a line item for tax savings, and you'll see there's a little bit of negative and positive. And then we have an owner's draw amount of $7,500 every single month. Okay. With this, you can see here that they've got some months where they're going into the negative. So they're spending more, and it really has to do with them going to these big conferences where they're spending a lot of money to do that. And then you can see their cash at the end of the period down here. Now they started with 50,000 at the beginning of August, and at the end of August, they were down to 33 because of their big spending on the conferences. And they don't want their cash to go below $40,000. Because basically they've decided that's about, one payroll run for them is 36,000. And so they've decided that they never want to go below that to where they might run into not being able to make payroll. Now, if we were to look at the end of the next year right now, they're only going to have $36,000 in their bank at the end of, 16 months from now, 15 months from now. That is not what they want. They have a goal of making $100,000 in cash, or having $100,000 in cash by the end of December 2024. And so if we were to lay out all of this right now, we have to say, hey, that's not going to get you there. What you're doing right now is not going to get you to the goal that you want. And to layer on top of that, they don't want to borrow any additional money because they're working on paying down their debt. And then they also want the owner here to be paid $10,000 a month rather than $7,500 starting in January of 2024. Okay. So we want to say, how can we make that happen? And this is where we can start pulling little strings, and we can start playing with this forecast, and we can say, okay, what can we do right now to make that goal? So the first thing I would say is we need to look at some of our expenses and say, like, is there something that we could cut? Because this client has told me that, they feel like their revenue is pretty solid. They don't think they're going to lose any clients right now. So if they just want to have more money in the bank, the first thing we can look at doing is cutting some expenses. So we had a conversation, and we decided that actually a couple of these conferences are not really necessary when we're not out doing business development. And so we're going to take out the December, and we're going to take out August. And so from there, we've said, hey, that does get us a little bit closer to our goal, but keeping in mind that the business owner actually wants to get paid more. So they actually want to get paid $10,000 a month rather than $7,500. So that spends money. We got some money back by removing the conferences, but then we spend money by paying the owner more money here. So that brings us back down to $46,000. So again, that's not where we want to be. And so we could, have a conversation with the business owner and say, hey, do you really want to go up to 10? But they say, yes, we really need to. And we really want to, because we've been working really hard and we should be paid $10,000 a month. Okay, fine. Where else can we cut? What we've looked at is looking at the marketing budget was pretty high at 10% of their total revenue. And then we really decided to look at it and dig deep and find some additional savings here. So we've realized that we could actually cut the marketing budget in half, especially if they're pretty happy with their clients and are not really needing to do a lot of extra, business development and marketing right now. So if we're able to cut that in half, we have come up with a projected cash balance of $131 by the end of December 2024. So this scenario is great. I mean, in this scenario, we're saying, hey, we're building up that cash balance. We're achieving the goals of the business owner by having them getting paid more. They haven't taken on any more debts. And this is like, if we can maintain this scenario, we will hit our targets. Okay. And that gives us a little bit of a buffer because, there might be some additional funds we need to spend here and there that might, we've got an extra $31,000 and we would still be reaching our target by the end of December 2024. So that's all great, fine and dandy. That's in the perfect scenario that we keep all of our clients and everything. But let's give scenario 2. And that's when you get the news that you've lost a client. So I think we've all been there where maybe we thought a sale was coming in or we thought a client was, good to go. And then it didn't happen or a proposal didn't go through or something. And, or you lose a client. Now that's happened to everybody who's been in business for any point in time where a sale you think you're going to get, you don't get. So I think it's realistic to kind of play through this scenario. So let's say that the largest client here, Monsters Inc. I just got all my fictional business names. Monsters Inc. as of, gave notice in December of 2023. And then in January of 2024, they decided to go with a different company. So we're actually going to remove all that revenue from the business. So ouch, that hurts. Like that's a lot of money to not be coming into the business. With that, that's going to flow through to our revenue line item here. You can see that the revenue went down from 125 to 104. And with that, it's definitely going to be affecting our cash flow. So let's look down here and we can see, ooh, yikes. We've got all this red. We've got a couple months here of like losing money. And then by April of 2024, we're actually way below our target cash of 40,000. And then by basically July of 2024, we're going to have to borrow money or we're going to be in a negative cash situation. Okay. So this is another reason why the cash flow forecast is giving us lots of great insights, because we can see right away, okay, we found out in December of 2023 that we lost that client, and we can put it into our forecast. And I can say, wow, okay, if we don't do something really dramatic, we're going to be having to borrow close to $60,000 just to break even by the end of the year. Okay. And we have a whole year to do something about it. So that's where I get really excited about the cash flow forecasting, is that, we have time to actually make things happen. And it doesn't have to be like, this huge dramatic thing where we find out something and then, we're just worried. What this actually gives us time to do is it says, okay, we actually can, start making changes right now. So one of the things that I would look at doing right away would be to look at our labor. So if we lost a really big client, that probably means some people aren't busy anymore. And the first thing I would look at doing is maybe not, instead of looking at our payroll people, because those are people we've invested in, they're people that we want to keep on the team. We have all A players around us. We don't want to lose any of those employees. The first thing we would potentially do is think, look what we could bring in-house with these subcontractors. And maybe we're able to take this down to something like $1,000 per month. rather than this variable amount here and there. So we're going to take on that additional labor for our team that has freed up capacity. And so that's going to help us a little bit. That buys us a little bit of time. We actually don't run out of cash until November of 2024. So pretty good, but we're still not reaching our goals here. With that, kind of looking over at our scenarios again. So we've removed our subcontractor labor, and then we've decided, you know what? We still have labor capacity in our team. We really need to go out and get a new client. So if you know in December of 2023, let's say by March of 2024, you can go and get a new client. But, you know, are you going to go and get another big fish as big as the one that you just lost? You know, potentially not. So let's go ahead and say like you get a new client and their new client is about $100,000 and it starts in March of, let's do this, March of 2024. Okay. So March of 2024, you have a new client and that's going to help you increase your revenue. So that's great. Okay. Still not back to the revenue where we were at 130 per month, but you know, it does help. Let's go back and look at our cash balance. Okay. You know what? We're actually not, we're not below any of the cash, or we're not below our $40,000 amount that we're saying, hey, you know, we want to stay above $40,000. So with that, we've got a couple other things we can do to say, okay, we've lost this client here and we've gained a new client. You know, maybe because we've lost that client, we really need to have a frank discussion with the owner to say, you know what, maybe now is not the right time to take your $10,000 draw. Just since the profit isn't there the way that we want it to, we need to be realistic. And unless we can get and replace more services or, you know, more work, we're not going to be able to do that $10,000 draw. Okay. So now we've gotten the client back up to $75,000 in cash by the end of the time. Oh, sorry. And then with that, we can also look at, get to my right screen here, 75,000, we're still short by about 25,000. So in this case, we're going to look at how we can maybe shave some costs off of our conferences, knowing that now we maybe can think about, maybe we only need 2 people to go to this conference instead of the 5 that we have planned. We're going to take that down to $10,000 per conference rather than 25. Okay. And this would be internal discussions that we have with the business owner. This is not necessarily, you know, saying that this is the right decision in this moment, but this is why you talk it over with your advisors and you think about strategically, where's the right place to put your money? Because there's going to be trade-offs with any kind of decision like this. There's going to be times where it makes sense to really invest in conferences. And there's going to be times where maybe it makes sense to pull back and really focus on maybe other types of networking or other types of business development. So look at, here we are, with all of these things, we're able to still hit our target of, you know, we could probably shave a few dollars off here and there and make sure that we have that cash at the end of 2024 by, you know, even being able to weather something like your largest client going away. Okay. So, I mean, that largest client was $250,000 in the year. And we were able to still figure out the things that we needed to do and the strings that we needed to pull in order to get to this, this dollar amount. So I think all of that is a really good example of things that we could be doing to help kind of look into the future and figure out what we need to do. Now we also have here, you know, employees. So I didn't actually play with any of the employees in this scenario, but, you know, let's say that you did have an employee potentially like need to be let go. So you could also look at that and say, okay, what happens when labor cost goes down? And, you know, what would happen in that situation? You know, you could look at that, like if there was one employee that was serving that really large customer and you weren't able to utilize them in any other kind of way, you could also look at the cost of, you know, what would it look like to remove that payroll off of the, off of your whole payroll expenses. With people, we really want to be really careful before we just cut people because we think that, you know, we can't, you know, that we don't need them right now. We want to think about, the bigger cost of losing employees. And whenever you lose an employee, the cost to like rehire and retrain someone can be about, 50% of somebody's annual salary. So if you think that you could just go and get another client rather than letting somebody go, definitely think through that decision before you just cut employees left and right, just from a human perspective, but also from a financial perspective. Okay, so those are some scenarios of how you can use a cash flow forecast. And so I'm sure there'll be a few questions that we'll definitely get into in the Q&A section. But that gives you like a really good sense of, from a management perspective, what types of things you could be looking at here in order to use a cash flow forecast to your benefit and see into the future. So that's Pure Joy Agency. I'm going to tell you guys a couple tips for maintaining a cash flow. I've kind of gone over a couple of these, but here we just have, you want to update your forecast, weekly at, kind of the maximum probably, and then monthly at a minimum. You want to keep that on that regular cadence of keeping your cash flow forecast updated. It's really good to have somebody dedicated to this on your team, because the more familiar they are with it, the quicker they'll be. And that may not be you as the business owner. Honestly, it probably shouldn't if you have any kind of like financial team around you. This might be, your outsourced CFO. It could be, if you have a bookkeeping team or something, they might be able to do some of this for you. But I think it works best when you have somebody that has an operational view into the business and they have the financial view. So I have seen like a director of operations or somebody do a cash flow forecast if you don't have a CFO. And then this also could be you as the business owner, just you sitting down and working through your cash flow. As you get more and more comfortable with it, it'll be a lot easier and it won't be a lot of time to maintain. This is not meant to be perfect. I mentioned that before. It's to give you like a directional reference point and something to work with. And, think about all those moving pieces that, you lose a client, you want, you have these, financial goals, you need to cut, your marketing budget, you need to do all these things. How can you keep all of that in your head? You can't. Like, nobody can do that. You can't keep track of all these little variables. So in that situation, like, you want to put it into a tool like this, and this is going to point you in the right direction. This is a management tool. It's not a financial statement. You don't use it. You wouldn't send this to your bank or anything like that. So keep that in mind. This is for you to use as a owner of your business and to help you make decisions. And then, like I said before, like reviewing like 6 to 12 months of revenue and expenses will help you. If you don't have a budget, will help you kind of figure out what numbers you need to put in there to forecast into the future. And then just thinking about planning for unusual activities. So plan for what you know and modify for what comes up. That's why we revisit this, on a weekly, biweekly, or monthly basis. You modify it as things change. So maybe you want to invest in a new marketing strategy, or maybe you have an opportunity to get a really great staff on your team. You modify and increase those payroll expenses or increase those marketing expenses as things come up. I like to have a buffer of cash that will really help. So you can know and, keep that, saying maybe it's $40,000. Maybe it's, for you, for different businesses, this could be $1 million of a buffer in cash. So it all depends on the volume of your business and what that regular monthly churn looks like. So you can figure out like what a buffer looks like for you. Use the tool to do like what if scenarios. What if we bought that equipment in January rather than November? What if we, invested in marketing in March rather than December? Use it to help you figure out what is the right timing and then also the right amount. And then just always remember there's trade-offs between, maybe we can't do an owner's draw extra if we've just lost a big client. Maybe we can't invest in the marketing if we want to hire that new admin assistant. So, keep that in mind. And then if you do want to do all those things, how are you going to make more revenue? How's more money going to come in? And then also keep those goals in mind. And all of those things will help you plan around your cash flow forecast. Let's see here. So I know we're coming up on Q&A time. Before we get into it, I will just let you guys know how to get a hold of me. We're available on at Clara CFO Group on pretty much all of the social channels. YouTube is kind of where we have all of our financial education. And then we've just started the Financial Clarity podcast. So if you're a service-based business, definitely check out that one. And I invite you to connect with us there, and also reach out to me directly on LinkedIn if you want to have a chat. So, all right, I think we are at that place.
Thank you, Hannah. So thank you so much for a great session. We had a question come in kind of early, which I think would be helpful just for helping people use the tool.
Yeah.
So in the cash flow forecast template that you shared, if someone were to switch to a weekly time frame, how do they measure cash at the beginning of the period?
So you're going to still probably use your weekly, you're going to have to start at some kind of like starting point, which you would typically look at your balance sheet at a starting point. So you could also look at your bank balance. So when you or your bank statement. So if you're looking directly at your bank statement, or you're online and logged in to your bank, you can see very clearly like what's the bank balance at a point in time. So if you want to start at like kind of an odd week, you can go and look at your bank for that.
Okay, great. And we do have a few folks on here who maybe don't have revenue just yet, or income. They're just getting started. How do you recommend they navigate the cash flow forecasting, when they're starting from zero?
Yeah. So I think that it's an incredible time to start using it, because you're going to start, even if you don't have, regular revenue coming in, you probably are going to have expenses. And so this is a really good time to start getting a really clear on like how much money you should be spending, and how much you are spending, or maybe how much you've committed to. Like maybe you're building a website, maybe you have hired some contractors to get you to do some things, you bought a computer, you're getting going, maybe you're buying some initial product. If you put it into a cash flow forecast over a couple months, you're going to be more well equipped to actually ask for the right amount of money from a bank or from an investor or whatever it is. You're going to have a much clearer sense of how much money you really need to get going. So focus on the expenses, and then the revenue is kind of like that, that unknown number that you can calculate and say, okay, well, if I know I'm spending $50,000 over the next 5 months, I need to go and ask the bank for maybe 60 to 75,000, something that's a little bit more than what I know I'm going to spend upfront.
That is great. And I think that works well with another question that we had. Some businesses feel they have unpredictable revenue. And so how can they, one, get a stronger grasp on making their revenue more predictable, and then two, forecast in a way that accounts for that fluctuation? And I think that this could absolutely apply to someone who has like a seasonal business, or where they sell the bulk of their products or services at one point in the year.
Yeah. Okay. So yeah, the kind of two really kind of both really great questions. I'll address the unpredictable revenue piece first. So a lot of us, especially when we first start our businesses, we're selling and then we kind of don't know, it takes a little while to get some traction. So one of the biggest things you can do to kind of help even out unpredictability in revenue is actually think about what's happening before the revenue. And figure out what is successful before you actually achieve revenue. So if that's like networking and creating leads and generating leads, you're actually kind of starting to build like a pipeline of work. That can kind of help. If you are constantly working on your pipeline, you can start to try to smooth out your revenue a little bit more. Now, what's good is that if you have unpredictable revenue, you can start to see like the gaps. Let's say if you're a service provider and hey, I have work in August, but I don't have work in September. I don't have work in October, but I do have a project in November. You can start working on your pipeline to fill that out kind of ahead of time. Like you can start to say, okay, I know I need to sell something for October. I know I need to sell something for September because I don't have anything there. So I think like it's really about trying to like see into the future and try to kind of do the work now to sort of fill in that. And the other big thing I would say about that is that unpredictable revenue is partially result of your business model. So how you've chosen to develop your business and sell things. Sometimes you have choice over how you can, change your business model. So if it's really like, if you're project based and it's really, really spotty, maybe you want to think about how can I do like a retainer service rather than always working on these projects. Now, some people love projects and they're always going to be projects, and that's where you really need to develop that pipeline. And I'm very passionate about this. So, but I think like the unpredictable in revenue, you want to think about like, what can I do to kind of put it into the forecast and plan for it. Maybe you don't make big investments when you don't have any money coming in. So put that into the model. But, also think like, can I change this? Maybe I don't need to be a victim to this like unpredictable revenue model. Maybe I can have some power to kind of smooth this out in the future. And I think there was a second part of that question. I got a little carried away.
Oh, no problem. That does cover a lot of what we were thinking of, but the second part was forecasting that accounts for that unpredictability, which I do think you touched on.
Yeah. The unpredictability piece is really definitely part. Oh, I think the other part of the question was also when somebody has the bulk of their revenue being earned at one period in the year. So that is also something that, let's say you're seasonal and Q4, I mean, like product businesses, for example, like there's so many e-commerce business that they earn, maybe 60% of their revenue all comes in Q4 of the year. It's really important for us to make sure that that is put into the model so that we understand that the profits from that's happening in Q4 need to be able to sustain for a few months until we can kind of get sales back up. So this is another great tool to actually use to help say like, okay, I need to not just be like, hey, I can keep this sales going, like, because we know that that's not, true. We need to like use that extra cash that was made in Q4 and help it sustain us through Q1 and Q2 of the next year. So
that is so helpful. Thank you, Hannah. And let's see. Okay, so that does sort of tie into a question that we had. If revenue for some of these e-commerce businesses, for example, if revenue comes in the last month of the fiscal year and it's for the next year's services. So I may have misspoken, not for e-commerce businesses, but let's say the revenue comes in the last month of the fiscal year and it's for next year's services. Do founders need to enter that into their spreadsheet or identify that revenue differently?
So, I mean, there's kind of like the tax part of that you always need to consider if you're cash basis or your accrual basis. So just remember that if you're cash basis and you receive cash before the end of the year, like you're going to need to pay taxes on it. So make sure. I know that's not the question, but it's something I have to say being a CPA. But then from a cash flow perspective, I would include that money in cash flow and maybe even like put it on a separate line item of like maybe like deposits for services or something like that. So you can see it clearly. We have those revenue line items that could be customized. Maybe instead of like, general services, you could just put it on a separate line item so that it triggers that memory of, oh yeah, that's why I have extra money right now, is because I got paid a deposit.
Got it. And then do accounts receivable count as cash in, or does that only go into a line or become a line item once those have been paid?
I would only include that cash once it's been paid. So, because really you want to think about cash. Is the cash actually available to me? Is it in my bank account? Is it like usable right now? So in that situation, don't include accounts receivable unless you've received it, which then part, it's not accounts receivable anymore.
Right. Okay. Very helpful. But it is kind of hard to like visualize, I think, or to get their arms around for some of our entrepreneurs, since
yes,
that it may be such a long time before you actually do see that money based on payment terms and things like that.
There was actually like a really, I was using for a little bit a software. I don't use it anymore, but it was a software called Float. and they actually had the ability to change the date that you thought your invoice would actually get paid. Because sometimes, we send out an invoice and it's like net 30, right? But you might not get paid until day 45. And so if you're projecting your income based on the net terms, that could, kind of screw up your cash flow if you're not going to get paid for another 15 to 30 days or something like that. So you want to think about, when do you realistically think that the money will hit your bank? So if you know that a customer is really late paying all the time, don't optimistically think that that money is going to come in, because it just might not, until, what have they historically paid in the timing?
Right. So it comes down to knowing your industry, or really your clients.
Yeah, knowing your clients, doing your best to kind of speed up some of those things. I mean, I do have a lot of tips to help increase and get paid faster. You can do things like enforce late fees. You can offer early pay discounts. You can offer ways for people to pay you faster. You can accept credit cards and just, include that credit card fee in your pricing structure. So, there's lots of different ways to kind of incentivize, pay me faster.
That's great. That's easier than having to kind of play the game of chicken of, is it going to come on day 31 or 45?
Right.
Yeah. So is there an ideal income to expenses ratio, and does that vary by industry?
Well, there's going to be naturally some businesses that are just going to be a lower margin business. Like something like a grocery store is very, very, very notoriously low margin. Like they will typically be getting 3 to 5% on their business. And that's not margin we're talking about, is revenue minus expenses, what's left over. Service-based businesses, I really like to see 20% in profit. So that's revenue minus expenses, profit. We like to see 20% of revenue to be a great target. I think that it is different based on industries. And, if you're a product business, you've got to really think about is your cost of goods sold really high? Is it low? There's definitely lots of different things there, but you want to think about, is it sustainable in the long term? You need to be making a profit. So, and then usually having a really low margin, couple percentages, unless you're really, really, really high volume, can't really sustain a lot of small business owners. A lot of our small business owners need to be compensated out of profit. So, you need to be thinking and factoring that in as well.
So helpful. We had someone ask, we have a lot of variable costs. Do you recommend using averages or even weighted averages for those expenses when putting them into the cash flow spreadsheet?
Yeah, the variable costs there's a lot of different methods to do it. I like to think, does the variable cost have a variation based on something else on your P&L or on your forecast? So cost of goods sold, for example, is it a percentage of revenue? Or if you're going to have a variable cost on maybe a great example is your variable cost might be your credit card fees, but credit card fees are always 3% of revenue, maybe, and you take credit cards for everything, it's always going to be 3%. So you can kind of build in a formula to say this moves with revenue. And then you can also do averages for sure. You can also look at if it's a trend. So if it's a trend based on prior year, you can look at prior year and kind of predict okay, I think it's going to grow 10% over last year. You could literally just take 10% of last year's number and plug it in, and the variability will be there. So there's a couple different methods you could use, but you would just want to think through logically, what do I think is going to happen? And kind of don't overthink the math, and just more think of practically, what is happening in this account?
Right. And it sounds like that goes back to using the cash flow spreadsheet more as a directional tool than, down to the cent.
Yeah. And you're going to look at it every month or,
Mhm.
you know, and so you can say, ooh, I was really off last month with my projection, and I need to like maybe come up with a better way of projecting it this next month, or, you know, in the future. So you can always kind of like test yourself and say, okay, well, how close was I with the balance? Did I get close to the projected balance at the end of the month, or did I not? And do I need to make some changes?
And if the forecasting is way off from the actual expenses for a particular month, should that business owner then readjust the amount in the forecasting spreadsheet from that month moving forward, or just kind of think of it as an outlier and stick with what they've been working with?
What was the first part of that question? I kind of.
Oh, sure. So if the forecasting is way off from the actual expenses for that month, how should that business owner react?
Yeah, I think that's a good question to just say how was I so far off?
Mhm.
Was I off on revenue? Was I off on expenses? And then what you can do is just kind of like change your beginning cash balance to the new actual cash balance. So instead of like changing all the stuff that's happened in the previous, just be like, okay, restart, new month. I'm going to put the actual cash balance up at the top of the spreadsheet and then have all the math work from there. So just kind of don't go back and try to change your previous stuff. It's gone. It's already done. But use that information to say, do I need to change something in the future?
Right. And then, so we are getting close to time, but I will want to kick this to you. Will an accountant do this kind of forecasting for a business, or is that something that like some business owner should bring in a fractional CFO or a full-time CFO to do?
Most businesses probably don't need a full-time CFO. You usually are going to be $50 million plus in an annual revenue before you would need a full-time CFO. Some accountants will do this for you, but a lot of bookkeepers and accountants are really focused on historical only, and they don't focus on how to make decisions for the future. Some will. So just have a really frank conversation with whoever it is that you're working with and say, like, is this something you do for clients right now? Not like, is this something you can do for me and only me? Because then they might not know how to do it all the time, but is it something that they do for clients, for other clients that they have experience in forecasting? You don't want to necessarily have somebody who's just trying to figure it out just for you to make a little bit of extra monthly income. So other than that, like a fractional CFO would absolutely be able to help you with cash flow forecasting.
Yeah. Okay. That's great and so helpful. We have had experts on before say, you know, you absolutely should work with accountants and bookkeepers, but to have a better sense of what their roles are is really helpful to empower our entrepreneurs.
Absolutely.
Okay, so we are almost at time. Hannah, is there any last bit of advice that you'd like to give to our audience, or you know, what is the one thing they absolutely need to know?
I think it's just to not be scared of this process and to know that it's a practice. And so with any kind of practice, we get better over time. And so just starting somewhere is the best way to start. And then going from there, you can keep refining and keep getting better. And as you get more comfortable with it, it's going to help you more and more in your business. So just go start forecasting your cash.
Well, great. Thank you so much, Hannah. We are so grateful for you for sharing your expertise with our community. I know that a lot of people got so much that they're going to take away with them, and we